What is going on, guys? It is your boy here, TB at S&B. Happy New Year's. Today is January 2nd. We're filming this. Stocks are closed, and I don't have anything else to do today, so I'm like, shit, let's upload a cute little video. And I just want to talk about. Oh my god, my cat is going ape shit over there. I want to talk about what I'm looking forward to in this next upcoming year, and just a few scenarios I wanted to run us through. I wanted to look at some historical data, some past trends, a lot of talk out there of this next year being a much better year for stocks, which after, on average, once you get like a down year, like a 20% year down, on average, you usually see at least around a 14 or 15% rebound the following year. But I want to run through and just talk about why I think that might not happen, how likely I think that is to even happen, if it even can happen, and just want to look at some data and talk about it a little bit. And then there's some news about Tesla. Tesla had some delivery numbers come out today that missed projections by about 4%, which is a very small miss. But right now, we are in that mode where any sort of news is terrible news, and any good news is still bad news. Any great news is neutral news. Any bad news is horrendous news. Any terrible news is absolute panic selling news. We're in that mode right now in the market. So we'll talk about Tesla, and I want to throw some price targets out for Tesla where I think it'd be a good buy, where I personally would love to buy Tesla. But first thing first, I like this little article Yahoo posted. S&P rarely dips 2 years in a row, but history says 2023 could bring even worse pain for stocks if they don't rebound. So really what it's going on about, the little spark notes on this is when we have a red year, if it is followed by another red year, that second year is always worse than the first red year. And that's kind of what I want to talk about. And I want to talk about why I think that's actually probably a little probable. It's actually not the craziest thing to think about, given the climate that we're in right now. That's the ultimate gist of it. S&P's only seen back-to-back down years on 4 occasions. That happened in 1928, Great Depression, World War II, 1970s oil crisis, and during the dot-com bubble of the 2000s. And we're really going to narrow in on the dot-com crash, which is obviously the most similar crash to the one we're in right now, where it was just a mass euphoric bubble. Anything that was even close to being a website, that was anywhere close to doing anything on the internet, just saw like insane, like 10x, 15x returns. And it was just a huge bubble. The Nasdaq just got to insane heights and dropped almost 85% by the end of it. I think that is our kind of the situation we're in right now, where these past 2 years are just so euphoric. Any SPAC, any little shitty company that was doing any kind of innovative thing just shot up like out of a cannon. And we are seeing those they've already collapsed, most of them. You look at companies like, you look at even solid companies like Square. I mean, you look at Square and you think, man, this thing might never see these highs again. It straight up might never go back to that. It is down 82%. You look at Upstart. I mean, this thing is down 97% on Upstart. Let's go to Affirm. This thing here, oh my goodness. This thing here down about 95%. I mean, it's crazy. This was just the climate we were in. If you were a tech company and you IPO'd in 2020 or 2021, you saw insane gains, absolutely insane gains almost across the board. There are few tech stocks that IPO'd that didn't end up going absolutely crazy. Here we got Skills. This one is almost my favorite. This thing went up from about $10, this was a SPAC, I believe, to at its height, it was at like $46, and now we're trading at 50 cents a share. I mean, what? Are you kidding me right now? That is, you can't even compute that loss. That's like that's straight up a 99% loss. I mean, Jesus Christ. And that was exactly what it was like back in the dot-com bubble. Any IPO that was, hey, we do business on the web, was just like, boom, gone. It's gone. Buy now, ask questions later. And unfortunately, the problem with that equation is when you buy now, that later, where you have to ask questions, eventually happens. And it happens when we get to a time where the stock market's not just all fairies and fucking unicorn dust and everything. I mean, when you start to ask those questions is when those stocks just completely collapse and you start to see the drop, and the drop has been epic. I mean, it has been epic across the board. You look at the Nasdaq, it's down. What do we close the Nasdaq down? Close that Nasdaq down about 36%. I mean, that's a rough year. That's rough. And now this stock market's a lot different than the 2001. I'll grant that. Everything's changed. The retail trading thing, you couldn't trade options back in 2000. You couldn't even trade them back in like 2009. So this is a completely different stock market. But you still look around the market and you still see things that are fundamentally overvalued, like Microsoft. I mean, Microsoft is only down about 33%. It is outperforming the Nasdaq. Apple, my favorite example, the one that has been holding the entire shit show together this year, is down only about 30%. Google. Now, mind you, these are fantastic companies. I'm not saying these are bad companies. Google's down about 43%. So Google's been rough. Amazon, but really like Microsoft, Apple, those are the big ones. Those are the juggernauts of the tech sector. Probably put Google up there, probably put Amazon up there. But really, Microsoft, Apple, they are holding everything together. Amazon has always been a weird stock because they just burn through so much freaking cash. They're down about 57%. But Microsoft, Apple, still pretty overvalued. Tesla, still overvalued. Google, still overvalued fundamentally. P&E's still in like the 25s, you know. So we're entering this next year. Still haven't peaked on our interest rates. So that's like the ultimate bull case. I'm going to talk as if I'm the biggest bull ever. All right. So we know where interest rates are going. We're going to get to the top of those this year. And then we'll price that in, you know. Companies will get used to making less money, right? Earnings will come in lower, but we'll be expecting them to come in lower. So that's why I think this next year won't be very painful. I think we'll know where the interest rates are at. We see inflation's coming down, but the sticky thing is unemployment. And that's a huge, huge part of this equation. We still have that unemployment at about 3.7%, which is inflationary, very inflationary. That's incredibly low unemployment. When unemployment is that low, inflation is just going to go up no matter what, because you cannot have that much power on the labor side of it. You cannot have the employees having that much power over the employers, you know? You got to see unemployment up in like the 4.5 range, which if next month we got an unemployment read where unemployment went up a full percent, I mean, it would be chaos in the streets. That would be full-on capitulation day. That would be the recession. So that is really another point you got to watch out for. But if I were to be an ultimate bear, I would say, well, we haven't even topped on interest rates. Interest rates take that full year or full 6 months to a year to take effect in the economy. So we still haven't felt the full effect of all the interest rates yet, because we haven't even stopped jacking up the interest rates yet. The Fed has not given us a clear time on when they plan to pivot and cut interest rates, or if they ever will. No, they say they will, but we don't know when. We don't know until how low. We don't know if inflation is fully dead. We've gotten some good inflation reads, but those can always just flip. Like back in the 80s, they would do that all the time. They jack up rates, inflation goes down, drop rates, inflation goes back up. So we know Powell he has made it very clear, even though he flip-flops and he's been fucking wrong left and right. I think they realize now that the only thing that they can do to save this is by making sure inflation is completely, and I mean completely, dead before they drop rates. Because if they pivot too soon, shit just goes right back to where it is, and we are back in the shit. Inflation comes back, it creeps back up over 4%, over 5%. They want it to be at 2%. And then we got to do it all again. And then that is so much pain, because then if you do it again, if you go through another softening cycle where you drop rates, and then you go through another tightening cycle, it is just more doubt in the second time around. There's more doubt in the stock market. There's more doubt in the economy. It's like, well, we lasted through one tightening cycle, but let's just say we go through a second and we still make it out on the other side, which I know we always do on the other side, but you don't know how long, you don't know how much pain, don't know how much earnings are going to get hit, don't know how many jobs people will lose, yada, yada, yada. And it is very concerning that unemployment hasn't even moved. I mean, this is the highest, quickest that they have jacked up rates. Let's see if I can get a nice little chart. Let's see. I want to find a chart that shows past tightening cycles. Come on, here we go. Yep, here we are. So this is the past time that we have gone through that we've gone through tightening cycles in modern history, pre like 19 or post 1980, I believe. Right here, this dotted line is us in 2022, and you can just see how insanely quick we have jacked up rates compared to past times. We have gone at a much quicker speed than any. This line is just going straight up, and it is still going straight up. You can draw the rest of it. This article doesn't have all of this because this must be from September. So this is going all the way up to 5. And notice that none of these lines ever got up to 5. They never even jacked up rates that high. We're going higher than we have in the past like 30 years, faster. So the fact that we're doing that and unemployment is just not moving is scary, because then you have to say, well, we have jacked up rates of 5%. We've seen inflation go down. Now we can drop rates. So to say they drop rates, they drop them down to like 2.5%, 3%. What's to stop inflation from just going back to where it was when unemployment is still so low, where the labor market is still so tight? That is inflationary. And they know that. So they know that they have to force that unemployment number to move up. They have to force the pain. They have to force not a recession, but close to one. They have to, because if they don't and unemployment just stays where it's at, then raises just keep coming in. People still keep getting raises. You have pricing power. Companies still keep jacking up prices because people are still just paying them. You have to get to a point where they can't keep raising prices because people are refusing to pay them. And we are just so far from that. We aren't even close to that. People are still traveling like crazy. People are still taking vacations. People are still buying cars and shit. We're not even close to that. The housing market is slowing down, but that hasn't even come down. People are just sitting on their hands well, I'll wait like 5 years to sell my house. Why would I drop my prices 20% to make sure I can sell my house when they know prices are just going to go up? So that's the bear case for we are still very far away from being at the bottom, because we are not even really feeling any pain. I mean, the stock market has been feeling pain, but GDP was positive last quarter. So we are technically out of the recession. Like, we got that 2 quarters of negative GDP, and then we got a third of positive GDP. So, and GDP is 70% consumer spending. So you have to take that into consideration, that, hey, consumers are still just spending because they're still getting raises. They haven't lost their jobs, yada, yada. And it's a shitty part of the equation is that you have to feel pain. There has to be people losing jobs, has to be people, losing jobs. And that sucks, but that's just the way it is. And if it isn't, then inflation just goes right back up. So anyways, now, and then my little tangent is basically tightest, highest, quickest tightening cycle in modern history. Insane, just vertical. We're just going vertical with these rates. And we are going to end up past where this chart even goes to, 5%, which is where they want to end up. Unless, and that can always change. That's the other thing, is right now what the Fed is saying is going to change. There has not been an instance this past year where the Fed has said something and then they haven't changed what they said like 3 months later. Why do you think there's been so much pain in the market? Because we keep pricing things in, and then the Fed comes out and then they say something else. They change their mind. They say, hey, we got to go higher. We got to go quicker. We're not going to drop rates. Yada, yada, yada. They give us a different roadmap. When are we going to cut rates? Who knows? We changed our mind. So that's part of why I think this next year will be red. And if it is red, history tells us, even though it's only happened 4 times, that it will be much redder than this last year. I know that's hard to imagine, but you just have to think about look at the Dow. Let's look at the Dow Jones. So the Dow Jones is not a lot of tech. It's mostly industrial, obviously, the Dow Jones Industrial Average. This thing is hardly down, and I mean hardly down. Look at this. It closed the year down 11%. I mean, this is made up of companies like McDonald's. Let's look at McDonald's. Look at McDonald's. It's sitting at all-time highs. Let's look at Coke. It's sitting at close to all-time highs. Let's look at Caterpillar. All-time highs. Let's look at John Deere. DE. All-time highs. Let's look at United Healthcare. Oh, son of a bitch, it's sitting at all-time highs. Let's look at all the oil companies. Those are all sitting at all-time highs. So this is why I still think there's a lot of pain, because it's very clear. It's so clear what has happened this year. People have just taken their money out of the Nasdaq and put it into the Dow Jones because it's safer, because it's not so, I mean, it goes back to value. People are looking for value, but the irony now is that these value stocks aren't even a good value. You're paying the most for these quote unquote value stocks than you've ever paid right now. They are so high. Things like McDonald's and Coke, I mean, Jesus Christ, these things are near all-time highs. It's crazy. They saw a little dip, but these things are still high. These value stocks, they're not value now. They're high. They're sitting at 20 P&Es. Let's look at Kroger. Kroger, I mean, grocery stores have kind of got hit because supply chain and whatnot. But so that's kind of what's just happened this year, is that it's not that money's really left the market. I mean, sure, a lot has. It's gone into bonds, but a lot of it has just gone from Apple, Google, Tesla, to McDonald's, to Kroger, to United Healthcare, to all these companies that hardly even get phased by higher interest rates and that are still seeing high demand. That's the thing about like, the construction industry is booming right now. Everyone's still buying heavy machinery. Caterpillar is killing it. I mean, look at this thing. It's at all-time highs. It's crazy. You would think demand for these would drop, but they haven't, because the economy hasn't slowed down. So that's why stocks are going up in this sector, and that's why people are just taking that money from tech, where things are slowing down. We know they are, and they're just throwing it in the Caterpillar. Like, why not? Even just to sit in there, not even to make gains, but the fact that you could have made some money on Caterpillar this year is insane. If you bought Caterpillar, you bought it at 206, you're up like 15%. That's a great return year over year. In this stock market. So where I think we will go red is where people just start to sell everything. And that's just, we haven't gotten there. We haven't gotten that panic mode where it's like, I don't want my money in the stock market. We just aren't even there yet. We haven't gotten there. There's no telling if we will get there. But if we do, that's what I'm saying, is that these names are going to sell. You'll see some red. You will not just see these keep climbing if the market actually does see a full-blown recession where unemployment does go up. But yeah, that's really just what's happened. That's why it's felt like such a painful year, because a lot of retail traders like myself are married to stocks like Nvidia, AMD, Tesla, all these fun all these fun stocks that do like volatile things that were fun to own these past 2 years. Now they're not fun to own. And believe me, I can tell you. Jesus, look at United Healthcare with this rising wedge. I feel like there are going to be a lot of good opportunities to short some of these freaking stocks, man. Look at that perfect rising wedge on United Healthcare. Jesus. Anyways, that's kind of what I'm seeing. I think this next earnings season will tell us a lot, and I mean a lot. It is probably the biggest earnings season we've had in a decade, probably since like the Great Recession. It is going to be so telling on what things are looking like for this next year, because it will be the earnings of Christmas, the holiday season. We will see a lot of information about retail. It'll just tell us so much about consumer spending. And if we do see a big spike down, that is where people will get worried. And I think that is what we're pricing in these past couple of weeks, or this past week, especially on the market. Especially if you look at the Nasdaq. I mean, Christ, Nasdaq is just bleeding. This thing is bleeding. Help. It's sick. It needs some milk. Actually, I mean, it was a solid choppy week. But I think that's where the market is heading first. We're just going to look at that earnings. We're going to look at the next FOMC early February. And yeah, really, it's hard to find the bull case because, I mean, so this is what people do. It's a psychological game. We are right now in a time where everything seems so bearish. And often it is hard to buy when everyone seems so bearish, but a lot of people are just buying because they're like, yep, everyone's bearish. Everyone's bearish. Look at all these puts. That's the other thing. There are more puts held in circulation. Open interest on puts is the highest it's ever been, ever. So a lot of people are just like, yep, all these puts are going to get squeezed. We're going to see some squeeze because everyone's short. And that's absolutely an insane way of thinking. It makes sense when things are undervalued. When stocks like Meta and Alibaba, those are objectively undervalued. I mean, you can argue that it's China, so it's a piece of shit. It's Facebook. Zuckerberg sucks. But on paper, those are undervalued. As for the rest of the stock market, we aren't even close to that yet. If you think we're close to anything being undervalued, we aren't. That's how big of a bubble 2020 and 2021 were, is that things are still not overvalued. Tesla is still overvalued. So I get that argument. Get bullish when everyone's bearish, when stocks are fundamentally, technically undervalued and prices are so low that you're seeing P/Es in the single digits. You're seeing high growth stock P/Es low. We aren't even close to that yet. So that's why I think it's a bunch of dumb shit to think that dumb shit. Really good vocabulary. I think it's very flawed logic to be like, right now I'm buying because everyone's so bearish. So therefore things can't keep going down. It's like, of course things can keep going down if everyone's bearish. What are you talking about? It's just like, would you have said that back in 2020 and 2021? I mean, people were saying that. People were buying SPY puts in April of 2020 because everyone got so bullish. All of a sudden, everyone's so bullish in 2020 and 2021. Does that mean you were shorting the market because everyone was so bullish? So that logic has to go both ways. Of course, you weren't shorting the market back in 2020 and 2021. Everyone was bullish, but everything kept going up. So with that logic, things should have come down. Well, they didn't until this year. So I think that logic is completely stupid. I think it's absurd. I think it is like classic dumb money thinks that. Dumb money is just like, well, people are selling, I'm going to buy. And now, mind you, I'm talking as a trader. I'm not talking as a, like, 15 years from now. Yeah, if that's your time horizon, buy now. You won't give a shit about this 5 years from now. I'm just saying these next couple years. And that is where I'm at. Because I still think things are going to come down. Things are still overvalued. Like, it's just, you can't even argue. I mean, yeah, it's just because this is what people do. They have recency bias. You just look at how high things were and how far they've come down, and that is why people are like, yeah, things are a good buy now, when they still aren't. Like, that's just how overvalued everything was. That's how insane it got at the peak of 2021. That is how crazy things were in November of 2021, is that things were just so insanely overvalued. So you cannot think that, oh, hey, since we are so far off of that, we must be undervalued, because it's not true, because that was just pure euphoria. That was just gonzo, just everything, unicorn, fairies, wizards, nothing was real. And that is a thing that a lot of people forget. But we do know that inflation's coming down, so that helps. But really, I don't know. I'm not here to make predictions. I'm just saying things don't feel like they're ready to rebound yet. I mean, it is weird to say feeling because you don't want to trade with your feelings, but it just doesn't feel like there has been enough pain. And that is objectively true because we haven't seen unemployment even move. We haven't seen stocks have come down, tech stocks, but not a lot of the big ones. Barely. I mean, Microsoft and Apple down 30%. That sounds terrible, but it's like, well, they just were so overvalued. They're still $1.5 trillion companies. Apple's still worth well over, I think, 2, right? Or no, it must be almost 2 trillion still. But those are still great companies. I'm not dogging on the companies. I'm just saying. But that's what I'm looking for next year. I'm just looking to see if it's true. If we do see some bullishness, if we do get a soft landing, but I don't know. This year has been so wishy-washy. Things are terrible. Things are great. Things are terrible. That it feels like once we see that volatility come down, we can finally look forward and be like, yep, things actually do look pretty good now. But I still just think there's too many questions. There's too much mystery going into this next year. And that is ultimately the fear of the unknown is what causes stocks to come down, because the stock market is trying to be priced for the next year to year and a half to 2 years. So that's why you see things come down quickly. But let's look at Tesla. Let's talk a little bit about Tesla. I know everyone wants to hear about Tesla, the big news. Tesla car sales grow slower than expected. All right, so from a bull standpoint, growth 40% year over year is great. That's fantastic. They reported their year-end vehicle production. Fourth quarter, Tesla reported 400,000 vehicles. That's great. Production of 439,000. That brings Tesla full-year deliveries to about 1.31 vehicles. That's great. I mean, they're booming. They're doing fantastic. But I think according to consensus analyst estimates compiled by FactSet, Wall Street was expecting Tesla to report deliveries around 427,000 for the final quarter of the year. Estimates updated in December and included in FactSet range from 409 to 433,000. So yeah, they missed those estimates by just a hair, which I don't think is that big of a deal. But it doesn't matter what I think. It matters what the stock market thinks. And right now the stock market has been panic selling Tesla. I mean, Jesus. So that's interesting. And that is ultimately where the bull case, that's the weak foundation of the bull case for Tesla. There are so many Tesla bulls. It is so hard to find any objective opinion on Tesla because it is a whole different stock. It is in its own universe of rules. It has such a cult-like fan base. You got people who are cult-like fans of Elon Musk, cult-like fans of electric vehicles, of just tech in general. And Tesla just has all of that, all of these things. So that's why it's hard to get real opinion on Tesla. But what I've seen from the bulls on Tesla is that it's just demand is just going crazy. And that is really the worrying part, is that if we do see a real recession, and we are seeing some demand in China, because their estimates and their their projections for these next few years of revenue is based on this demand that is just endless, that just keeps going up and up and up. So if that were to not be the case and we did see demand just stop growing, that would be horrendous for Tesla, because Tesla has priced in so much of this inevitable demand that they think is going to happen. And that is what is scary about when we get these numbers, is that the bear case is that demand will actually not go up as much as they think. And when you get news like this, it kind of backs that up, that demand is not as high as we think. It used to be back a couple years ago. I mean, I know production lines and everything are all screwed up, supply lines, but it used to be you have to be on a wait list to get a Tesla. You had to be on a wait list for like a month or so, and now it's like you can get a Tesla, you don't have to be on a wait list. So just from that, production has caught up, demand has come down a little bit, but yeah, that's the bear case, is that this demand, these projections are way over projected. They are too high. They don't think that demand is actually going to come up as high as they do. And if that's true, that is very scary for Tesla, because it has baked into its market cap, into its price, it will eventually just keep seeing that growth that they project. And if it doesn't, if we start to see demand come down, we start to see a recession where rich people stop spending money. That's where you get the recession, when rich people are finally like, all right, might need to tighten our belts. And that has just not happened. Rich people are still spending money like crazy. They don't give a shit about a recession unless it's like a real recession, and then they get scared. And that's what Tesla is. That's what their customer base is. It's the rich folks. It's the upper class, people that can afford it. So that is what's happening with Tesla. I still think Tesla can come a ways down. I've said it before in my videos. I believe Tesla can come straight down to fill this gap. I think it's definitely filling this gap. We're definitely seeing $92 on Tesla at some point. We're definitely going to see at least $75 to $70 on Tesla. And at that point, I would think it's a solid buy, just because it is a very quality company. This is panic selling. This is emotion. I think it's a good company, but it's still overvalued. But like I said earlier, just because everyone's bearish doesn't mean you get bullish. You get bullish if everyone's bearish while things are undervalued, but things ain't undervalued. Tesla is not undervalued. It is still a little bit overvalued. So that's what I'm seeing on Tesla. I think Tesla will see, $70 to $75 easily. I'd love a good solid buy there. But Tesla, just a lot of pain ahead for Tesla, I believe. But let's look at the rest of the stock market. I want to do these little projections here and then come back a year from now and see if I was right. So on the SP 500, we're down. What are we down? Down about 22% year over year. So like I said, if we do get another red year, it's almost always, when you get two consecutive red years in the stock market, the second one's almost always worse. So let's assume we get a minus 30% drop this next year on the S&P 500. So we come down 30%. What would that put us at? Ooh, man, that would put us down bad. We would be down in the 260s on S&P 500. Now, that seems a little bit overblown to me. So maybe 25% drop from where we're at right now on the S&P. Let's just say 288. I think that's where we'd see the S&P 500. If this next year is as painful as this last year was and we see bigger drops in the stock market, I can see it at about 288. I'm going to put that level there. And future me, let's see if we were anywhere close. I think that's not crazy, but let's see. Let's see what happens. I'm going to leave that on my little chart here, and let's see if that level comes into play. I think that'll be interesting. Now, to the upside, say we have a bullish-ish year. We see a 15% to the upside, typically. So, yeah, I think the biggest bullish scenario is we close above 435 this next year, if we do get a bullish year. End of year bull prediction. No notifications. Realistically, I think personally that we will just see pre-COVID highs on the S&P. I could very easily see 340, 330, see it bottoming around there, but anything can happen. Looking at the Nasdaq. Oh boy, the Nasdaq. And I've told you guys recently in videos about the Nasdaq with this volume gap ish that it has. If you draw a volume profile from here all the way over to about, let's say over here, you can see the volume gap. So you see this, you see these little red bars. There is so little volume in this area. I think bears are going to be able to yank us through this area very, very easily. I could see the Nasdaq coming down to 220. Oh man, that doesn't even sound low enough. I think Nasdaq might see COVID lows. We could see 200. I'll say 200 on the Nasdaq. Let's put it about 200. I think that's very doable. It is obviously on track to make that. This pattern, I mean, if we did see about a 50% retracement, we've already seen that. Yeah, shit. 200. I'm thinking 200 on the Nasdaq. I could see it. And it just is Apple, Google, Microsoft, if those all start to sell off, it's very doable. Those are massive weights on the Nasdaq. But to the upside, I think Nasdaq, if we close at 330 next year on the Nasdaq, I think that would be huge. I think that'd be crazy. So that's my upside target, 330. But like I said, pain ahead for the tech sector, I think. A lot of pain. So that's my little year in review, where I'm thinking next year will look like. I know it's a long video. I kind of dragged on a lot. But thanks for watching. If you did, drop a sub, drop a comment, drop a like. I appreciate it greatly. And let's see. Let's have a good year. I'm just going to try to keep learning this next year. That's my New Year's resolution. I went into this year thinking I knew jack squat about the stock market. And boy, oh boy. Everyone's a genius in a bull market. Let's just say that. It's easy making money in the bull market. Bear market is where you get humbled, where you wake the fuck up and the market says you don't know jack shit. And I think I've ultimately learned a lot, and I will continue to learn this next year. And that's really all I aim to do. If I can make some money on it, then boom, I'd love to. But I think as a trader, you have to plan on struggling for a while, especially in a market that is terrible like this one we have been in. So I will just continue to learn, and I hope you guys do. I hope you guys join me in that journey. I think this will be fun, and let's see what this year brings us. Take it easy, folks. Thanks for watching.